You had been saying sell before that. I'm curious, why the upgrade now, and why specifically neutral?
Yes. So, Morgan, if you remember, our thesis on Apple was really centered on the iPhone and this idea that the iPhone 12 did so well that it dried out the market for the iPhone 13. So this idea that you have only 600 million people in the world who really buy iPhone on a first-hand basis, and if 250 million of them have bought the iPhone 12 or most that, then there isn't that many left for the iPhone 13. And we were expecting that, something that happened already in the past, in 2019, in 2016. And what we saw in the last sprint is like a very, very strong quarter and a very, very confident guide that goes really head first against our thesis. So the quality of demand for the iPhone today is something that is breaking our framework. There is something we're missing, right? And so if that's the case, then we don't really have any view that is in opposition with what you will find in consensus today and what we think is relatively well reflected in the stock price. So at $165, that's 25 times what we would expect for earnings next year. And that's about what consensus is expecting for earnings next year, $6.60. And so we feel the stock is probably reasonably valued, so we don't have a strong view on the name, and that's the rationale behind our neutral rating.
Yeah. I mean, and what you're telling me is that you're acknowledging that you got it wrong in regards to Apple's recent results. And, of course, there's the expectations for the current fiscal year. What would change your mind, though? I guess the fact that you are staying neutral right now. I mean, what are sort of the key factors that you would expect to potentially accelerate the gains in this stock that you would be looking for that you don't think are there currently?
Yeah, that's a great question. I think if you look at, the existing established business of Apple, the iPhone, iPad, the Mac, the wearables as they exist today, we don't feel like there is significant room for steady upside against existing expectations. So if Apple is a business that can grow in single-digit revenues and grow free cash flow and profitability along the same line, it's difficult to have more than a neutral perspective on the stock. We don't think there is anything mispriced or that is not getting priced in yet. So neutral, really, we mean it. We mean it's an okay investment, but that's not an investment for which we would pound the table. So what would make us change our mind with that kind of expectation in background and valuation in background would be really the next steps for Apple, which is like the VR or AR headset and the car, of course. And we've done a lot of work on this front. And our view today is that these opportunities are a mix of being extremely open-ended. So there are very good reasons to believe Apple can do very well there. But how well and how far is difficult to call. And then our second conviction is that this will be very slow baking opportunities. So we don't see an urge, in recommending investors to own Apple for these opportunities today.
Speaking of cars, you like Tesla. Why?
Yes, absolutely. I think Tesla is the exact, in terms of timing, the exact opposite. What we see today is that Tesla is producing right now, maybe on a run rate basis, 1.3 million cars a year. And expectations for this year is for Tesla to produce 1.4. So they're going to vastly exceed these expectations. We have earnings expectations for this year and next 35 and 31% above expectations. And the growth outlook for Tesla is not going to weaken in a year from now compared to today. On the contrary, in a year from now, the company is going to look even stronger. We don't really see we see competition coming in the market, of course, but it's like small companies who have ramp plans that are not going to overshadow Tesla. And traditional manufacturers are still struggling to put together cars that can really compete with Tesla. So the outlook will remain very strong, and earnings expectations will increase by 30 to 35%. So we expect the stock to do at least as well as that. And that makes it like a very strong conviction for this year for us, yes.
Shepard Smith here. Thanks for watching CNBC on YouTube.